सेव किया था ना?
मैं सिर्फ इसलिए गया था क्योंकि उसने मुझे कॉल किया, that's it. But listen तो.
Save it for someone else.
जिंदगी में सेव करना जरूरी है, मगर जब बात पैसों की हो, सिर्फ सेविंग से काम नहीं चलेगा। इक्विटी म्यूचुअल फंड्स में इन्वेस्ट कीजिए और अपने सेविंग्स को आगे बढ़ने का मौका दीजिए।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to this episode of Macro Sutra. I'm TCA Sharad Raghavan, Deputy Editor at ThePrint, and this time we're going to discuss what the IMF has said in its recent report and why the RBI is upset with it. To discuss this and also all of the constructive things that the IMF has talked about, we have with us Radhika Pandey, Associate Professor at NIPFP. Thanks, Radhika, for joining us.
Thank you, Sharad.
So now, Radhika, I know that what the IMF has talked about is quite a technical subject,
Right.
but in layman's terms, could you tell us what it has said about India's exchange rate and why this has upset the RBI so much, what the RBI is saying?
So the IMF has reclassified India's exchange rate regime from a floating to more stabilized arrangement. So in layman terms, it means that earlier IMF classified India's exchange rate regime as floating.
Right.
That is where exchange rate is determined on the basis of market forces, and the RBI only seldom intervenes only to prevent undue fluctuations in exchange rate.
Right.
But now it has reclassified India's exchange rate regime to something called a stabilized arrangement, which means that there is massive intervention happening. That is, RBI is intervening in the exchange market to control the fluctuations. It is RBI is preventing rupee from falling too much, which is depreciating, or rising too much, which is appreciating,
Right.
and therefore the exchange rate is more or less stable. So they look at the last 7 to 8 months, and what they have seen is that the rupee dollar exchange rate is more or less stable, and therefore that observation they have noted is on account of RBI's intervention, RBI's over-regulation. Some amount of intervention, they think that it is understandable to prevent disorderly fluctuations. But if there are excessive interventions to keep the rupee dollar rate stable, then that prompts them to reclassify exchange rate regime from floating to a move towards a more fixed one, which is this variant, which is a stabilized arrangement.
Right. So, I mean, just to make it absolutely clear, the IMF stance on this is that market determined is better and an exchange rate set by the government is worse.
Yeah.
Okay.
Yes.
Right.
So they think that, when there's a flexible exchange rate, it is the most proper response to a shock. When you allow exchange rate to depreciate, then, your exports will become cheaper. You will be able to export more. So let the rupee or let any exchange rate be market determined, and that is the first line of defense in the event of a shock. So according to them, flexible exchange rate with intervention only to address very violent fluctuations in exchange rate is the ideal policy response.
Right. And in this report, they've also incorporated the RBI's response. So
Right.
could you tell us a little bit more about that?
Yeah, so let's talk about this Article 4 review. So it is a review of India's economic, financial policies, structural reform, its fiscal policy framework, monetary policy framework, everything. It's a very comprehensive review of India's economy, and it is done by the staff at IMF. They visit India, they meet policymakers, they meet officials at the Ministry of Finance, they meet the RBI officials, and then they come up with this report, which is then placed for consideration of the IMF's executive board. So now at the IMF executive board, in addition to the board of directors, there's also an executive director for India. And currently the executive director for India is our previous
Chief Economic Advisor.
Chief Economic Advisor. So we also get to hear his views on whether the IMF staff assessment about India's economy, whether it is proper or not, or what are his views. So it does not incorporate RBI's views as much, but it has a section. It has an annex which is the views of the executive director for India on almost all the concerns that have been raised by the IMF in this report.
Right.
The reclassification, their concerns about debt, their concerns about financial sector. So on all those, they have there's a response by the executive director for India, and what the report contains is also the staff assessment, which is the IMF staff assessment,
Yes.
and their discussion with the Indian authorities. So in the course of that report, they have also reported what the Indian authorities have to say about that, and
Yes.
there they have said that the RBI is not on board with this, and because according to RBI, they have intervened only when it is necessary, and more or less the RBI says that the exchange rate is market determined because there is no exchange rate in their mind that they have to target. So when they do not have that, they are intervening, and that is the reason, and it should be termed as floating and not made stabilized arrangement.
And they also said that the IMF has actually looked at a very too short a time period, and that if you look at a longer time period.
Yes. So they have looked at their decision. This decision of reclassification is based on the time period from December 2022 to October 2023. So this is the time period. And if we look at this they compare with a 3-year period before that, that is 2019 end to 2022 end. And during that period, rupee depreciated by 15%.
Right.
And in this time period, rupee was more or less stable. And then because it is stable, they have termed it as a stabilized arrangement. But what is also equally important is that if it is a stabilized arrangement, it has to be due to RBI's actions. If it is not due to RBI's action, and if it is due to favorable market conditions,
then that can't be RBI's fault.
Then it can't be RBI's fault, and then it cannot be reclassified back as a stabilized arrangement. So the two criteria for terming any exchange rate as stabilized arrangement is that your exchange rate should be stable, that is, the fluctuation should be just 2% in a range of 6 months or more, and at the same time, this stability has been achieved due to official action. This stability has been achieved due to RBI's intervention, and there is the point of debate between RBI and IMF. IMF contends that this is all due to RBI's massive intervention, whereas RBI and Executive Director for India is saying that this is all not due to intervention. This is also due to the fact that FPI inflows have bounced back. Our current account deficit has improved. Our external sector is much more robust. Therefore, rupee has not depreciated too much. So that is the point and counterpoint. And the other, as you rightly said, that what is the justification behind taking this 8 to 9 month period? Either the IMF should give an explanation why they have taken this time period. And as it is, it's you're looking backward. You are giving an assessment based on an arbitrary chosen time period, and then you are reclassifying.
Right.
So, but there is no denying the fact that RBI does intervene, and RBI has intervened even before that. Even the time period when exchange rate was depreciating by 15%, even that time RBI intervened.
Of course.
And at that time, they did not reclassify our exchange rate regime. So, this entire reclassification seems to be too extreme a measure, and it's not justified why they have taken this time period.
Right. And now we've talked about this reclassification and all of that, but there are a larger set of kinds of exchange rates, right? There is there is all the way market determined, and then there is the set exchange rate. Could you tell us a little more about the classifications?
Yeah, so the IMF in its annual report on exchange market arrangements and exchange restrictions, so it is called IMF AREAER report. So there the IMF has come up with this classification of countries' de facto exchange rate regimes, and there are a wide spectrum of exchange rate arrangement, starting from one extreme, which is lack of a anchor, where you do not have your own exchange rate, you are completely depending on some other currency,
Right.
which is called as dollarization.
For example, the dirham, I think the UAE dirham is...
Ecuador, in these countries, it's complete dollarization. The exchange rate is completely on the basis of dollar.
Right.
So that is one extreme. And then you have 3-4 types of exchange rate regimes, which are classified as hard peg, where it's a kind of a fixed exchange rate regime, very strong, rigid kind of exchange rate regime. Then you move to a soft peg, where there are 2-3 exchange rate variants, which are soft peg, and then you move to floating arrangements, where you have 2, which is floating, and complete floating, which is free float.
Free float. Right.
So India's exchange rate regime was classified earlier as floating, where it was that exchange rate regime is defined as where it is market determined largely, but there are exchange rate interventions to curb undue swings in the exchange rate.
It's what we call a managed float.
Managed float, yeah. So
Right.
in our terminology, in central bank speeches, you will see that we call it as managed float, which also gives us an impression that, it is managed. It is managed through exchange rate intervention. So there is no denying that fact. So there is a very thin line, what is managed and what is float. So that is there. And then you have a complete free float, where the exchange rate interventions are kept to a bare minimum, only left to reserve for very extraordinary circumstances. Otherwise, it's complete market determined. So there are these 10 kinds of exchange rate regimes that the IMF has as part of its AREAR arrangement. And what we have seen is a reclassification from floating to a kind of pegged exchange rate, a variant of pegged exchange rate, which is the stabilized arrangement.
Yeah, right. So now, apart from the IMF getting upset with us, what are the actual downsides if our exchange rate is perceived to be more managed than floating?
So it actually doesn't make much of a difference, because firstly, it is based on a historic backward-looking indicator, and it is for everyone to see, because we have the exchange rate data, and we also India is one of the countries that release its intervention data. Not all countries release their intervention data, and yesterday the RBI bulletin came out. We have the intervention data till October. So we know that the RBI has intervened, and we also know that even as we speak now, RBI has been intervening, because now you see foreign portfolio investors have bounced back. They are net inflows of FPIs, but even then the rupee is not appreciating. Normally, what should have happened, that if there are more dollar inflows, rupee should have appreciated, because there is greater demand for rupee to invest by foreign portfolio investors. But what do we see is that rupee has not appreciated. That means that RBI is still intervening and building its forex buffers. It is increasing its foreign exchange reserves and preventing rupee from appreciating too much. So it is, and right now what is happening is that RBI may be doing a number of objectives through exchange rate intervention. It is buying dollars. It is increasing the supply of rupee, because as of now we know that there is liquidity crunch in the banking system.
Right.
So there are a lot of things happening at this point in time. The only problem is that it tends to confuse the market participants. It confuses the market that, what the RBI is doing, whether it is wanting to prevent appreciation or prevent depreciation, or whether it is doing two-way, because what we do see is that RBI is preventing appreciation also and depreciation also.
Right. So there is some managed.
There is a managed, and that is the scale and intensity has increased over the last 2-3 months, because RBI, we are seeing that suddenly the forex reserves are building. Our forex reserves are even more than $600 billion. And at a time when FPI inflows have increased, that automatically implies that the RBI is absorbing the dollars.
Right. Okay. And now, so we have a question from Sankalp. He asks, would the IMF's reclassification of India's exchange rate regime count any more than a terminological annoyance, which is basically like, does it actually matter? It's not like the dollar's current strength is marked by the US economic fundamentals. So how can the rupee be dubbed as being overvalued?
So it's not overvalued, as I said, that this reclassification is because over the time span that they have taken, which is from December 2022 till October 2023, the exchange rate moved within a very narrow band, which is around 2%, and that prompted the IMF to reclassify the exchange rate from floating to stabilized arrangement. And even, if we look slightly backwards in 2020, the US Treasury also put India on the watch list because the US Treasury also classifies central bank on the basis of how much intervention they are doing, because that may hamper their trade competitiveness, because if you are trying to keep your rupee artificially weaker so that your exports are cheaper, that tends to harm your trading partners. So there have been instances where India was placed on the watch list at the US Treasury, and in October, RBI governor made this statement that, this practice of putting emerging economies, currencies on watch list, it should be reviewed. Right. So there are these problems, but currently, as I said, that what needs to be questioned is the determination of this time period. And even beyond that, IMF itself has said that a de jure exchange rate regime continues to be floating. It is only the de facto, which is based on this 8 to 9 month
time period.
Based on this, they have reclassified the exchange rate as a stabilized arrangement. And even we know that our exchange rate is a managed float.
Right. So,
and RBI has completely dismissed this IMF's reclassification.
Correct. So that's actually what Anurag asks. He says that it's no secret that the RBI intervenes in the forex market. In fact, last year, our foreign exchange reserves fell by about 100 billion as the RBI intervened. So when does an intervention become too much? Is there a criteria like this by the IMF? And do developed countries which follow a floating rate regime also have interventions in the forex market to reduce volatility in their currency?
Yeah, so interventions to some extent is permissible and it is desirable. But when interventions lead to so much stability in your exchange rate, that your exchange rate is moving in a very, very narrow band, as in the case of stabilized arrangement, that, over the last 8 to 9 months, the exchange rate has been, rupee dollar rate has been broadly stable.
Right.
That means that intervention is too excessive according to the IMF's classification, and that has prompted them to reclassify. So when intervention leads to more or less stability in the exchange rate, so much so that, from a 15% depreciation, now we are only broadly stable. And it's only us, if we have done this comparison of rupee with some of the other broad major currencies, we see that other currencies are fluctuating. It is the rupee which is broadly stable. So
I see.
It is the intervention is definitely playing its part in maintaining the stability of the rupee dollar rate.
Right. Okay. And now moving away from the exchange rate, the IMF report has a lot of things in it.
Yes.
One of them has to do with India's debt level. So what has the RBI, what has the IMF said about our debt levels?
Yeah. So there is a big chunk discussion on India's debt sustainability. That is general government debt to GDP ratio, which was also what we discussed in our one of the earlier episodes, where we talked about IMF's World Economic Outlook, where they gave projections about Indian general government debt to GDP ratio.
Right.
So what we discussed during that time was that the global debt, surged to more than 100% overall. Household debt, private and public debt surged to more than 200% of GDP during COVID, and the public debt rose to more than 100%, and this spike was primarily driven by advanced economies, not by emerging economies, because we do not have that much fiscal firepower to keep spending so much. what IMF is saying now is that in the medium term, yes, India's debt to GDP ratio is quite sustainable, and we will see a downward trajectory of India's debt to GDP ratio. But in the long run, the IMF says that there are some risks to debt sustainability, mainly stemming from the fact that substantial investments would be required to meet our climate change commitments. So we would have to spend a lot on, because we have ambitious goals under our national development commitments, NDCs, we have targeted, we have kept some targets for climate change mitigation and adaptation that would require a lot of expenditure, and that could lead to debt to GDP ratio rising to above 100%. So that is the concern which the IMF has raised.
Okay, and so relating to that, Sankalp again has a question relating to the debt issue. He says that yes, our interest payments as a percentage of expenditure has been rising, but as he says, for him to lose any sleep about this matter, it would have to be the case that we are heading into an uncontrolled fiscal expansion, or our possible revenue stagnation, or some other really big financial commitments. So is any of this happening?
Yeah, so that's what the response of the executive director for India is, that even during extreme cases, when we had COVID related disruption, when we had the Russia-Ukraine war, that time also our debt to GDP ratio surged to 88%, 89%. And since then, even just the next year, we saw a significant reduction in our debt to GDP ratio. And even now, there is a gradual decline in our debt to GDP ratio.
Right.
And some of the good points, or some of the things that are comforting about our debt to GDP ratio are, firstly, that it's mostly denominated in local currency. So the exchange rate risk is low.
Right.
Secondly, that a large part of it is long term. So the rollover risk is low. That is the other comforting part of our debt to GDP ratio. The third part is that the quality of expenditure is improving. We are moving towards higher capital expenditure, which has the capacity to augment our GDP. And if our GDP increases, then the debt to GDP ratio will shrink over the medium to long term. And the other important point is that our tax buoyancy has been increasing. So that gives us comfort that all these things, all our fiscal variables give us comfort that, it's unlikely that our debt to GDP ratio will swell to above 100%, because till 2028, we do not see such a condition happening, and that is coming from the IMF's own projection itself.
Right.
So to think in the long term that something of that sort will happen is something slightly on an extreme basis.
Okay. And in your article, you also mentioned that the IMF had some useful suggestions for India as well.
Yes.
Could you expand a little on those?
So they have useful. One is the debt part, and the right thing that they say is that beyond 2028, if you want to steeply bring down your debt to GDP ratio, you need to have a more ambitious fiscal consolidation roadmap, which is very much true that we need
That's
to
something
have.
even we've talked about.
And that is what they have also talked about, that this is the time to bring up a post-pandemic review of fiscal responsibility legislation and revisit our fiscal anchors. What will be our debt to GDP ratio? What will be our fiscal deficit to GDP ratio? So that is what they are talking. And two additional points that they are talking, which are very useful. One is that our fiscal data reporting needs to improve. Okay, so central government debt comes on a timely basis, but overall, when we talk about general government debt, it comes with a lag. So there is a need to improve data reporting. There is a need to reduce the reporting lag. So that is one important suggestion that has been made. And the other is that not only the central government fiscal responsibility legislation, but the states' fiscal responsibility legislation also need a relook. And there they say that all states have different fiscal performance, and we've talked about that states are not uniform in their fiscal performance. So maybe there is a case to have different fiscal targets for different states depending on the state's fiscal performance.
I see.
So that will make the state's bond market or the yield on the state loans more responsive to the state's fiscal performance. Right now what is
if
happening,
you set one target for everybody,
yeah,
I see.
Right now what is happening is, and that's what we have seen in our empirical analysis also, a state like Maharashtra or Gujarat where liabilities to GDP ratio is very less, and a state like Kerala where the liability to GDP ratio is double of what is there in Maharashtra. In both the states, the yield is exactly the same. The yield on a Kerala bond and yield on a Maharashtra government bond is exactly the same. That means that the market is broken. There are distortions in the market.
Right.
And maybe, so they have this suggestion for the upcoming Finance Commission that they may want to have a look at the state's FRL, fiscal responsibility legislation. Is there a case to have differential fiscal anchors for different states so that there is greater accountability, and then the bond market is also more responsive to the state's fiscal performance? So these are some of the important policy proposals that they have floated to make our fiscal framework even more effective.
Right. So, I mean, that's actually really, really interesting, because some of the issues we've talked about, but this differing targets for states is very interesting. But on that note, that's all we have for you. The IMF says that the RBI has been exerting too much control over our exchange rate over the last 7 or 8 months. The RBI says that, look, 7 and 8 months is too short a period for you to analyze this. Not all of this stability has been because of the RBI. And so please don't, this reclassification is an extreme move. But the IMF has also talked about our debt levels. There again, the picture looks that, things are improving for us. Obviously, we have to keep an eye on our debt levels, but the numbers look to be improving. The IMF also has various positive suggestions for us, things that will improve our fiscal management and the way that we track the finances of the government and the states. So there's a lot in this report. It's the Article 4 report by the IMF for India. You should check it out. But on that note, that's all from us. Thank you so much for watching.